Hello, everyone. Good day. Welcome to today's webinar, Canada's State of the Market. We're very excited to be back to provide another national update on the Canadian real estate landscape. My name is Alice Dale. I'm Director of Valuation Advisory at Altus Group, and I will be your host today. Now, 2023 has proven to be another complicated year for both the Canadian economy and the real estate markets. From stubborn inflation, elevated interest rates, booming population, and post-pandemic shifts in how we live and work, there's a lot to unpack. Here to help us make some sense of it are my distinguished colleagues. We have Peter Norman, Vice President, Chief Economist, and Head of Economic Consulting at Altus Group. We have Ray Wong, Vice President and Head of Data Solutions. So we can start off with a quick agenda. Peter will kick things off with a macroeconomic overview. We'll then pass it to Ray, who will share his outlook on the commercial real estate markets. Peter will close with some observations on the housing market. And finally, at the end, I'll rejoin to facilitate a brief Q&A. Now, this leads me to a couple of housekeeping items. If you have any questions that you'd like to address during our Q&A, please submit them in the Q&A box. We'll try to get to as many as we can. And if we don't get to yours, we'll make sure that someone reaches out to you post-webinar. Everyone who is registered for today's webinar will receive an email and a link to the recording. So stay tuned for that email once we're finished here. And now, please welcome Peter Norman.
Well, thank you very much, Alice, for that setup. And thanks very much for all of you out there who have tuned in to join us today. We've got, between Ray and I, we've got such a massive amount of material to cover over the next 45 minutes to an hour or so. So we're going to kind of get going and get right into it. And I'm going to start with the macroeconomic piece. But just before we get going on that, we're going to just check in with you guys out there about what's going on, about what you're thinking about. And the first question that we're going to ask three questions throughout the presentation. The first one we're going to ask is about interest rates. So my question to you is, as a reminder, the Bank of Canada has, the Bank of Canada's key interest rate is at 5% right now, and it has been hiked by 125 basis points in the past year. My question for you is, by November 2024, do you think that that rate will be higher, will be the same 5%, or will it be lower at that point in time? And I think the poll is up in front of you now. You can just click off, and then we'll get kind of moving with the presentation in a minute.
All right, so Peter, I see the results here. It seems that the majority of our respondents are suggesting lower by November 2024. That's 54% of respondents. We have 34% suggesting the same, and only 12% have responded with higher.
Well, that's great. Thanks very much, Alice, for bringing that to us, and thanks very much for all of you out there for participating in this poll. What I really like is the optimism. That's great that we've got an optimistic group to begin with. We should really take the same poll at the end and see how optimistic you are after hearing us. But anyway, nonetheless, this is really great. I'm going to go through kind of a few different sorts of disruptive factors, a little bit like I did the last time around. Obviously, things are progressing, and we'll try to kind of keep things kind of updated in terms of what's going on right now on the macro side. I put population number one right now as a disruptive factor. Population growth, of course, very important in the end for the real estate sector. It's very important for the Canadian economy. But when it changes so rapidly, it's creating a lot of waves, which is creating a lot of challenges for us. A little bit of a reminder, a lot of people are starting to get familiar with some of these numbers, but just to put them in context with history, we have had over 1 million person population growth in the last 12 months, in the last year, leading up to the middle of 2023. That's double the pace of the year before, and it's about 3 times the normal pace of population growth. That's a doubling or 3 times pace in the course of just a couple of years. In fact, really, it's just in the course of the last year where this has gone up. As well, in terms of the composition of that growth, pretty important for us to keep our our mind on the fact that 98% of our population growth in the last year has been net international migration. It's been migrants coming in either as immigrants or as net temporary residents, workers, students, foreign students, and so on and so forth, coming into Canada. Only 2% of our population growth last year was due to what we call natural means, which is births, but it's births with deaths netted out. Our natural rate of population growth has virtually ground to a halt now. If we go back to the beginning of this chart, 40% of our growth was natural. If we go back one decade, which is a little bit before this chart, 50% of our growth was natural, 50% of it was immigration. So, not only do we have big numbers that we're coping with in terms of our economy, in terms of our macro, in terms of our real estate market, in terms of our assessment of how much housing should be built and where and how we get it done, and all of those big questions, we also have the idea that population growth dynamics have changed very, very dramatically at the same time, and those also impact all of those big questions. Population continues to be a disruptive factor. When we look across the country, I'm not going to spend a lot of time on this chart because there's a lot of numbers, but it's just kind of giving some sense of where all the immigrants are going, where all the, in fact, this is not just natural, but this is the flows of people within the country as well and what they're doing. And I want to highlight a couple of stylized facts here on this chart that's just come up in front of you right now. The first being that way over on the left, I guess left-hand side of the thing, we have a kind of a pre-pandemic benchmark. That's a decade's worth of data up to before the pandemic. And what was our growth like then? We were growing at about a little over 300,000 persons per year. And you can see the distribution. Most of them were either in Ontario or Quebec, BC, and then Alberta after that, were the major components of where migrants went. In the last year, of course, just in the last 6 months, it's almost 600,000. And last year, it's about and that compares to about 200 or about 900,000 the year before. But one other thing I wanted to point out is that the distribution of growth this year, 38% in Ontario and 15%, et cetera, in Alberta. A lot of people are kind of looking at, for instance, Alberta alone as being an area where there's a lot of migration going in and it's responsible for the strong economy. And Alberta's economy is running stronger and has higher prospects than elsewhere. But it's not just because of migration. In fact, at 15%, Alberta is capturing about the same amount of migration as it traditionally does. Ontario, marginally down. Other provinces either marginally up or marginally down, but no big shifts from that pre-pandemic benchmark. The growth patterns across Canada, pretty much what we're used to. It's only that the levels are a lot higher. Only area where we see a lot of change in that, or at least where something is dramatic that I think we should pay attention to, is Atlantic Canada. Of course, the numbers are lower because it's a smaller base, but Atlantic Canada is now accepting about twice the share that it has traditionally accepted in terms of migrants, and that's having an impact there as well. So a couple of stylized facts to begin with there. I want to switch now a little bit into inflation. That's the other thing that we've been talking about for 18 months now in terms of the impact on the macro. And again, just a little bit of context for you. I mean, the inflationary, I see the inflationary story over the last couple of years as having these multiple phases. I mean, we certainly had the pandemic that had a deflationary impact. We had a period of time when we were making up for that just almost mathematically after the pandemic as things were starting to normalize. Then we had this period of rapid inflation growth with the supply chain issues, some international issues, and so on and so forth. And really, we've seen inflation unwinding now for about 18 months, but not unwinding fast enough to, first of all, relieve some of the inflationary pressures that Canadian households have, but also fast enough to relieve the worries by the Bank of Canada that is leading them to keep interest rates high. And in the most recent monetary policy report, in their most recent communications after their announcement to keep interest rates steady at the last thing, it was actually pretty negative news that they gave. They made it very, very clear that interest rates are not, that inflation is not coming down fast enough, and that they see that this last little rise that we've seen are from pressures that are still in place. We have increased our chances of an interest rate increase going forward either later this year or early into next year, and that they will hold after that, and that the hold pattern will be longer. Most of you think interest rates will be lower in a year's time from now, as we saw in the poll, and I hope that you're correct. I think that the odds now are that they will be the same or potentially even higher a year from now, and that's having a lengthening influence on a lot of the issues that we're facing right now. This is the interest rate picture right here. I don't need to prescribe it very much. It's just an impact statement to say that we're at 5%. It's coming off of virtually zero, but you know, in recent years, we've been more like about 1 or 2%. So big dramatic change taking place, and that's on the right-hand side, which is the Bank of Canada rate we talk about. On the left-hand side, which is mortgage rates, which are affecting housing demand, and of course, it's also just a proxy for all sorts of rate-related impacts on real estate. Mortgage rates sitting at more than 2 times where they were during the pandemic period, certainly almost twice what they were even in the pre-pandemic period of time. And have they peaked? Well, not if the Bank of Canada moves again. And so I think that we're probably going to see a little higher before we see lower going forward. I shared this chart with you once before. I like the chart, even though there are some problems with it. But nonetheless, this chart is that these sudden interest rate spikes don't always kill housing. I think my message before was it was on the side of saying this one is not one of those housing killing interest rates. I am now getting concerned that we will see pretty dramatic slowdown and moderation in the housing starts in the next coming months ahead, and I'm going to speak about that a little bit more later on in the presentation. Our economic growth forecast is for virtually flat economic growth. I wouldn't necessarily call this a recession. I think it might, in the end, technically end up being a recession. We've had some sort of patterns where it was slow in the second quarter. Some of that was special factors like strikes, a little bit stronger as we went into a little bit stronger in the last few months through the third quarter as some of those special factors came off. But generally, it's a flat economy right now. And we've got it starting to pick up as we go back into 2024. That may be interest rates either coming down or starting to anticipate them coming down. There may be some other factors coming in here, but we won't really normalize at a better growth rate until we get sort of into 2025. As we scan across the country on that, all provinces seeing, sharply lower growth, of course, this year, pretty much all provinces other than Atlantic Canada, and further slowdowns or moderation in economic growth. Next year, even in Alberta, but less so in Alberta than most of the rest of the provinces. And a quick note about employment. Employment has been holding up, and it continues to hold up pretty well. I mean, we're going to be pretty close to 400,000 net new jobs this year, which is well above pre-pandemic norms, and that's pretty good. You have seen on the right-hand side there that there has been a kind of more of a slowing pace to a pace of around 200,000 per month on an annualized basis, but nonetheless. Employment growth has been holding up, more, better than you would expect during a period of relatively flat economic growth. Of course, a lot of this needs to be taken into context with the stronger population growth. So actually, we have the unemployment rate rising, which I'm not showing you right now, and that's because the strong amount of population growth, particularly immigrants that are in the labor force in their labor force years and are participating in the labor force once they come here, means that the labor force is growing faster than this employment growth. So we are actually not keeping pace with our capacity, our workforce capacity, but we do have at least some employment growth, and that's more positive than negative. And then my final statement before I turn it around is just to kind of remind you about household balance sheets, which continue to be more and more of a concern as we go through this year, particularly that debt service ratio that we're working very closely. It is shooting up really quickly. Our expectations for 2024 are for an even higher debt service ratio, particularly as interest rates continue to go up. The actual debt levels may look like they may have kind of leveled off or whatever, because has been a slowdown in new debt coming on, but nonetheless, debt service ratio concern for households in terms of their ability to participate in the rest of the economy in terms of some of those risk factors and so on and so forth. I'm going to be back to talk to you a little bit more about housing in a few minutes, but before I do that, I'm going to pass this over to Ray, who's going to talk to you a little bit about commercial real estate. So thanks very much for listening, guys.
Okay, thanks, Peter. Let's go straight into the poll. Okay, so and again, what Alice said in the beginning of Peter's presentation, there's a lot of sort of concerns going into end of this year, going into 2024. So the poll question is which of the following is your top concern going into 2024? Raising capital, interest rates, and the cost of capital, availability of labor, inflation, operating costs. So we'll just wait a few seconds to wait for the results.
Okay, Ray, we have some results here. Fairly overwhelming majority of the respondents, 66%, went with interest rates and cost of capital, somewhat unsurprisingly. Yeah, the rest of them came in pretty close to the bottom. That was an overwhelming consensus there.
Okay, great. So we'll get into the first slide, and I'm going to just go off of Peter's comments on the economic side. How will interest rates impact investment activity in 2024? So we'll go to the first slide. Basically, this shows you the volume of transaction activity, and sorry, this is for the first 3 quarters of 2022 versus sort of a year to date for 2023. And the numbers that are at the right of the chart shows the number of transactions. So this is not a big surprise in the way of the overall activity from the land transactions, both residential and commercial. That the biggest challenge there is finding capital sources for financing. But I'm not sure if this is surprising, but office and retail are probably about the same amount compared to a year ago. But what we're also seeing with a number of buyers, mainly on the private side, is the opportunity to redevelop and further growth or transition the property down the road. So in this year, we've seen a few sort of Class A transactions, and some of the vendors sort of reposition or being a little bit more strategic with their assets. Industrial and apartments continue to be the most popular demand, but the challenge there is actually finding sort of product, and as well as we're still going through sort of price discovery with a number of these type of assets. Hotel, based on the post-pandemic travel, is starting to get a little bit more interest from the investment side as well. Next slide, Peter. So we look at investor preferences. This is not, there's no real surprise here. Food anchor retail, multifamily and industrial continues to be strong. But again, sort of hotel comes up again, but this is sort of a bit of transition during the pandemic, and it's remained so. So when we turn to the next slide, when you look at overall investment activity, it's not as bad as we thought it was going to be. Based in 2022, we saw sort of a very active first half of the year, and with the interest rates starting, that we saw a fall off in the second half, and it sort of carried into the first quarter. And at mid-year, we were down about 50% compared to a year ago, but year-to-date numbers were a little bit higher. We're only about down 37% and sort of a year-to-date number. So that's a little bit more optimistic. When you look at the overall cap rates, and again, we're still in price discovery, what the vendors expect on type of returns, and as well as the lack of transactions in the marketplace. But what's important here is that when you look at industrial and multifamily residential, they're sort of up as well. And this is sort of also reflective of some of the product being sold in the marketplace. So we know from the poll that there's a number of different strong headwinds ahead of us. And again, the biggest challenge is the ability to secure some of that financing. But there's no sort of weakness in wanting to purchase. It's just from a timing perspective, and the lack of deals. It's sometimes a little bit more important to see some of the deals that didn't happen, in addition to the deals that did happen, and it just gives you an idea of sellers to a certain extent, or vendors or owners don't really have to sell. And one element that we're not going to touch upon in this presentation is the impact of ESG. Both investors and as well as tenants, occupiers sort of expect this movement toward environmentally friendly buildings, as well as the whole aspect of making it sort of climate proof. And this will sort of impact some of the challenges going forward from an operating standpoint and perhaps from a value standpoint going forward. So we'll turn to industrial. And basically, it's, you know, can the industrial rents continue to surge? And next slide, Peter. When we look at the overall industrial availability rates from Q4 2022 to Q3, the industrial availability rates have increased by 100 basis points, especially in Vancouver and Toronto. I wouldn't call it sort of a crack, but perhaps based on where with the economy sort of slowing a bit, that we are seeing, and as well as also impact with the higher rental rates. But this is its numbers are starting to move up, especially in the last couple of years. You didn't really see the availability rates move up, so it's not much of a concern because the availability rates remain low, and we are still seeing strong increases in rental rates. But it's something for us to watch going forward into next year. When you look at the construction perspective of it, it continues to remain strong, right? And the percentages on top basically indicate the availability rate of the buildings under construction. So it does look a little bit high, especially with respect to Toronto and Vancouver, but most of the space is already sort of committed just before completion. So it's not really a concern. I think we're still undersupplied, especially for some of for newer buildings and higher ceiling heights. But and this is a trend that we've consistently seen. Next slide, Peter. So the average gross lease rates, and you know, Vancouver and Toronto rents have increased by about 40%, and in Montreal by about 63% since 2020. And for tenants that have to be in Vancouver, they're actually being a little bit more creative with the space, because the option for some of them is you can't really relocate based on the mountains, based on the ocean, and there has been some movement to the Calgary marketplace. But Vancouver tenants that have to be there are looking at, you know, higher ceiling heights, but using technology to more efficiently use the product, as well as start to consider sort of hub and spoke models. But for the tenants that have to remain in the markets that have higher rental rates, especially on time of renewal, the options are relatively limited, especially if you're in the Vancouver market. Next, when you look at the buildings for sale, industrial demand continues to be strong as per the charts and as per the cap rates. And what we've also seen, because of the low, cap rates are still in the 4.5% to but wait to finance that acquisition, you're still looking at between 5 and 8% interest rates. But what we have seen is the return of occupiers that actually rather purchase rather than rents, especially with the rapid increase in rents over the last few years. And occupiers tend to be a little bit more aggressive with some of the purchases, especially if the space is vacant and it's still challenging from a financing perspective. And when you look at the aspect of industrial land costs, that Vancouver and Toronto have seen average prices since 2019 increased by about 65% and Montreal by 50%. So when you look at from a new construction aspect of it, and you look at the rents, even though they've gone up, it remains to be a little bit more challenging. So now we're going to turn over to the office side of it. And this whole chart here, we know that the occupancy is increasing for people returning back into the office. So the average weekly is around 54%, and the peak day, either Wednesday or Thursday, is 69%. And then sort of the Mondays and Fridays, you're looking at sort of 28%. So, but this is probably consistent, not just in Toronto, but across the board. The good news is that the numbers are increasing, and there's increased mandates from companies to have their employees back in because of certain sort of productivity challenges. But again, it's still moving up, but it continues to be a bit of a challenge because part of the issue is that there's the challenges enforcing some of these rules with the mandates with people coming back in. When you go to the next chart, we're showing the interprovincial migration, and this doesn't include immigration, the earlier charts that Peter showed, but it shows you a big increase or change, especially with Alberta. And I think a lot of that has to be based on housing affordability and sort of remote office work. And this positions Alberta in a very favorable position going forward, especially with the number of talent that we've seen in that marketplace. And again, we've seen so maybe go to the next chart here, Peter, showing the availability rate. So basically, this sort of shows you that with that change in with the employees, that Calgary availability rate is down about 23.9%. When you look at shadow space, it's probably a little bit higher than that. But the whole aspect here is that there's still mainly sort of on the resource and energy sector, but you are seeing sort of a little bit of diversity from the tech side and that growth in that area. So with the amount of talent that's moving in there, and it's not just on the office side, but you're also looking at the benefit from other sectors that were tight, especially on the industrial and some of that warehouse tech type of space. But the overall, when you look at the numbers, is that we're starting to flatten a bit to a certain extent. That based on I guess the next slide, Peter. Based on the shrinkage in the overall office sublet side, and part of it is you have to remember some of these sublets have been on the market for 2 or 3 years, so some of these sublets are actually burning off. We're still seeing sort of a number of blend and extends for the tenants that still want to be in space but are extending their terms, but also cutting back on their space requirement. And as well as we're also seeing rents continue to be pressured in the way of net effectives and tenant inducements, and for that continue to come down. But the good news is sublet is burning off a little bit. And when you turn to the new construction aspect of it, and this is the reason why the numbers are going to go up, similar to the industrial chart. The percentage, the bar indicates the actual square footage of under construction. The percentages above show the overall sort of availability rate for the buildings under construction. And for the most part, on the pre-leasing of some of these buildings, that we haven't really seen a lot of exits yet. We had a few deals, and the biggest one being Shopify in Toronto. But using math alone, when these buildings become complete, the availability rates, especially in Vancouver and Toronto, will continue to sort of tick upwards. We look at the overall leasing activity that we're a little bit down compared to a year ago in 2022. And last year we were at 12.3 million square feet at this time and 9.9 million now. So we're slightly off, but it'll be interesting whether or not this is the actual norm going forward, because back in 2018 and 2019, that's also a little bit inflated because of the pre-leasing activity. When you turn to the next slide, which is basically the by tenant or the type of leases, and expansion is low, sublet's coming down just because there's less opportunities, and renewal continues to be consistent. And basically the next slide is showing the overall demand for the Class A space and less on the B and C. So I don't think this is a surprise to anyone. When you look at the whole discussion of office to residential conversion, does it make sense? And getting back to that whole ESG thing, this is a strategic group's transformation of Beltline office in Calgary. It's called the Cube Residential Project, and was completed in 2019, but it created 65 new rental apartments and avoiding demolition, saved about 8,000 tons of landfill material, and the conversion allowed the building to be updated to a green standard. So it really depends on risks as well as the unknowns. So that's what's sort of pushing us. But for the city of Calgary, who implement that sort of conversion subsidy, they're already at the max number, so they're oversubscribed to that unit. But the one point to remember here as well is a conversion not from the office side, but we're also seeing some conversion, especially with retail over to industrial side, and as well as from some of the office over to the industrial side. So it remains to be seen see how this makes a dent into the overall numbers. I think minimal at this point. So when we go to the next slide of some of the demand drivers, we know that the office is going to be impacted. Office is going to be impacted with the growth of AI and the tech sector. Tech sector is going to remain very strong, but from the aspects of AI, again, efficiently integrating multiple layers of data and the key insights almost immediately. The opportunities for efficiencies, because this is the only way, especially in the office side with returning rents, to really shore up their performance by looking at overall efficiencies, reducing costs, and maximizing the technology, and as well as being sort of a little bit more proactive in trying to dictate how to run the building more efficiently, and as well as the increase in productivity of workers, and as well as the global economic impact. And it's predicted by the year it'll contribute to about 15.7 trillion to the global economy by 2030. So again, this is going to have impact going forward, and not just from an office demand perspective. But the next slide basically shows you the industries that will be impacted, and this is not a big surprise. I think we had this in our presentation about 3 or 4 years ago, pre-pandemic, the sectors that will be impacted. And from a productivity standpoint, the next slide, Peter, that it will make workers a little bit more efficient. So that whole discussion right now of a possible 4-day work week instead of 5, that this may get us there a little bit more quicker with AI and the potential impact down the road. Okay, next slide, Peter. So a lot of the discussion last year is hang on until 2024. Now we're saying hang on to until 2025 plus maybe, but it's going to be a bit of a challenge going forward. And based on the concerns that were in the earlier poll, that we're still going to see continued constrained finding capital sources, especially for office and land, continued seller and buyer price discovery, and especially with sellers that do not have to sell. Multi-res and industrial investment demand remains strong. However, buyers are trying to avoid, where they can, negative leverage because the rents don't really support some of those increasing. And as well as we're going to see increased operational cost challenges, and we need to find efficiencies via AI or other areas. So return to the office is improving, but I think we still have a number of questions going forward on that. Okay, so that's basically a summary. So Peter, I'll turn it back over to you to cover the residential side.
That's great. Thanks very much, Ray. And here we go, progressing into the final stretch of the presentation. We're going to talk a little bit about housing, a little bit about how those macro factors are affecting housing that I talked about earlier, and even some of those risk factors that Ray has been talking about, and where we go forward. But before we do that, surprise, surprise, it's time for a little poll to hear from you. Now, what I'm asking about in this question, I'm going to be talking a little bit later and giving you some data about projects that have been put on hold, how a lot of and many residential developers are pausing their launches recently. They may start them up again, but pausing them right now, and that's going to have an impact on housing starts. We understand a lot of that is because of the high interest rates and the impact that that's had both on financing and on potential demand, etc. My question for you is that if higher interest rates have been affecting projects and putting them in limbo, what kind of a reduction in those rates will be needed in order to get things going? So should it be at least 2 percentage points, at least 3 percentage points, or at least 4 percentage points? And there's also some answers that sort of you can say that any reduction at all will just lead to a flood of new projects. And of course, you can also answer that you don't think that interest rates are the issue. There may be other issues involved or other things that have put some of these projects on hold. So let's just see how you guys are seeing the residential sector, and in particular with this issue going forward about how fast will it come back when it comes back. I'll just give you a moment, and then Alice will go through the results.
Okay, Peter, I have some results up here. We got a little bit more divided this time. So 40% of respondents have said at least 2 percentage points. Kind of divided at the top between it doesn't matter and any reduction in interest rates will lead to a flood of new launches, about 23% for each of those, and not many respondents went with 3 or 4 percentage points.
Well, that's great. I mean, I think probably my thoughts align with the audience pretty closely on this one. I do think that there's that some amount of interest rate change will start to bring some projects back, but probably 2 percentage points are the sorts of things that's going to move the needle on some of the economic issues on the financing of these projects. So anyway, more to come as I work through some material. Got a fair amount of material here, a few minutes left to talk to you, so kind of let's get started. First of all, as per always, I tend to keep my eye on the resale market as a kind of leading indicator of what's happening in terms of housing demand and what that's going to mean for the new housing sector. And on that front, you know, resales have slowed substantially. There's lots of discussion in general. I mean, a lot of the data that you see in the newspapers is very high frequency, and sometimes it's good news, sometimes it's bad. But in general, we had resales decline quite a bit into last year from the year before, but only to a kind of regular, kind of normal level, or at least recent normal level. And we have seen some very modest declines year to date so far in 2023. But on some respects, and I put this kind of pattern chart over on the right-hand side of your figure here, in some respects, really the pattern of housing, of home sales right now, pretty similar, kind of both in terms of level and also in terms of the pattern throughout the year to pre-pandemic benchmarks. And so really a lot of the higher frequency concerns people might have about home sales have been more generated by the weird patterns over the period of 2020 through to 2022, more so than the more normal markets that we're starting to see coming through. That might seem odd, given that we've got those high interest rates and they're having an impact. And I think they'll probably have more of an impact as we go forward, both on the supply and the demand side of the housing sector. There are certainly lots of issues in the resale market that where we'll see some turmoil and flux in the months ahead. Airbnb is one of those where we're starting to see more and more of those purchases that were intended for short-term rental kind of coming back into the market now. Again, that's part of that is interest rate driven. Part of it is a softer market for those short-term rentals, where we may also see people who are in modest mortgage distress as they're renewing at higher rates, also leading to new supply coming into the market. So we might see supply come up, might have an impact on sales, etc. So there's going to be some turmoil ahead, but bear in mind that generally we see patterns that are pretty normal actually so far this year. And on the price front, we have definitely seen through this interest rate cycle a price adjustment. But I would say for most markets now, the price adjustment has mostly played its course. We're starting to see prices leveling off, and we're starting to see some upward pressure on prices in key markets. And if Bank of Canada raises rates again, if mortgage rates start to follow up, we might see that leveling off again a little bit. But I'm not seeing any major dramatic declines in housing prices going forward. I think that it's going to be pretty stable actually, and I think that most of that has played its course right now. Now turning a little bit to new construction, new home sales. And these are Altus data, of course, that are collected and disseminated to our clients through the Altus Data Solutions website. And this gives us a pretty good view on kind of a cross-country patterns that are going on in terms of new home sales. And what's important on this, we're just looking at single-family sales right now. It's important in terms of single-family sales that it's a little bit of a mixed bag across the country so far this year relative to the year before. We certainly see some markets like Edmonton and Montreal where we've seen pretty dramatically lower new home sales than we've seen the year before. But we've also seen, you know, several large markets like Calgary and Toronto, where they're kind of, you know, either steady or more or less steady, let's just say, with the year before, and some suburban markets such as Hamilton, where we've actually seen a fair amount of increase in new home sales so far this year. As we're looking at the condominium sector, a little bit more consistent data across the board. We are seeing condominium sales down about 30 to 40% in most markets across the country. The Greater Toronto area, I'm going to focus a little bit more on some slicing and dicing there in a couple of the next few slides, not to be regional, but partially because it's a good examination of some of the trends that I think are happening elsewhere as well. But this slide is kind of here to remind us that actually that experience in Toronto of down about 45% is fairly similar across the board so far. And even in Calgary, it's not quite as dramatic a decline in apartment sales, but there is decline even in the relatively stronger economic environment and migration environment, as has been pointed out, and some of the same challenges with bringing projects forward and finding buyers and dealing with the changing dynamics in the investor market are affecting markets across the country. As I promised or alluded to, I am going to focus a little bit on Toronto, in part because this will give us an idea about trends which are affecting elsewhere as well. These are, I spoke already about the dramatic declines in sales across the board, mostly coming out of the condominium apartment sector. New home sales for single family actually up slightly, but very, very low levels by historical standards for the single family. So let's just focus on the apartment sector. And as we look over onto that right-hand side, those declines have all been since the second half of last year. And that, of course, is when the interest rate started to rise. It very much is a question of a market in the last 18 months with the higher interest rates relative to before. And I have already spent some time letting you know that housing demand, at least as seen in the resale market, hasn't been as dramatically affected by the interest rates as before. So the households, at least so far, are not showing these kinds of dramatic declines. So what's happening on the condominium apartment sector are primarily two effects. One is we've got less product, available because we've got launches that have paused, and there's less supply available to buy. And then secondly, one of the major components of condominium apartment sales, which is to the investor market, has also dried up in a lot of markets. And we see, not only investors not so interested in new product right now, at least currently, but actually even on the resale market, I failed to mention this before, we're starting to see more of that investor product also coming into new supply on the supply on the resale market. So it very much is a question of this period in the last 18 months of the higher interest rates. And if we do look at inventories actually, continue to be relatively compressed by historical standards, certainly in new single family inventories, which continue to be very, very low by Toronto standards, by historical standards. Inventories on the apartment sector, we are seeing starting to creep up, not to more normal levels of around 20,000 units available. Remember, these are all off-plan inventories, or for the most part they are. But we are starting to see them creep up from those very low levels during the pandemic. Now this is a complicated chart. I only want to make a couple of important kind of stylized facts here, and they're ones that we're going to take forward with us as we continue this narrative. And over on the very left-hand side is mostly what we're going to focus on. And as a little bit of a primer, I mean, as we go through the last, even through the pandemic period, generally developers were bringing somewhere around a little over 30 new projects to market every quarter in Toronto. And those launches have gone down in half, almost in half, in this higher interest rate period of the last 18 months. This is about single family or low rise projects, but we had about 30 projects coming on each month, and each one I think is about 40 units or something like that, and we've seen half as many of those units, half as many of those projects per quarter. That's the dramatic decline that we're talking about. A little bit of a mixed bag in terms of how many units are released, because that depends on what size the projects are and stuff like that. But generally speaking, what we're seeing is it's taking longer to sell out each project. And that's why those percentage sales over on the very right-hand side have been fairly dramatically falling over the same period as well. We actually have more projects out there because they're not selling out, and they're lingering a little bit longer with inventory in them. That's the single family side, and all of these are pretty lowish numbers because single family is a little bit constrained right now in terms of sites. But on the high-rise side, pretty much the same story. It hasn't gone down in half in terms of the launches, but it has gone from about 27 launches per year to something closer to about 15, per quarter, I should say, and that's coming forward. These launches, of course, through 2020, the ones that didn't come forward, let's just say, in late 22 throughout 2023 so far, these are housing starts for next year and beyond. That's the way that the lags work. So we'll see lower housing starts going forward, not just because the sales were lower that we've seen, but there are just fewer projects to start. And that hasn't showed up yet, but it will be showing up as we go into 2024 and potentially into 2025. And I guess I'll just reiterate again, the same trend we're seeing elsewhere. I'm just not showing every single market as we go through the piece. And then just moving back in those time lags a little bit further to the land sales. Ray's already showing you this at a national level, and it's a fairly similar magnitude of data, but I just wanted to illustrate it in the same context of what I was talking about. Through this higher interest rate period, we have seen residential land transactions also decline quite dramatically on average. They're still happening. There's still land transactions happening, but dramatic. And so these are potentially, this is high-rise residential, well, these are all residential land, but these are potentially projects that would be typically launching in 2000, let's say 24, 25, and starts for 2026, 27 or whatever. That's with the lags that happen from the transaction period right through to the potential construction period. So this fairly dramatic decline in land sales probably will be a kind of a harbinger for weaker construction activity as we go through, even beyond the current horizon as we go forward. Other challenges, of course, I don't think I could do a residential piece without just reminding you about the dramatically high hikes in construction costs certainly through the pandemic period, but even with the moderation in those increases in recent quarters, they still continue to be positive. We still continue to see the cost of construction. Where I'm looking at here, apartments, single, commercial is a little bit flatter than in recent quarters than it has been for the other segments. Doesn't really matter whether we're looking at Toronto or kind of a national average. We're still seeing construction costs rising. That continues to be a challenge for developers, regardless of the interest rate environment, and that continues to be a challenge that needs to be managed. So just to kind of round things up, at least in terms of the new construction side, this is a national view that we're looking at right now. Fairly dramatic changes on the housing start side going forward. They haven't showed up yet. I'm showing you some high frequency data that even into September, our most recent data showing very, very strong housing starts across the country at well above 250,000 units on an annualized basis. But we're looking at dramatically slower housing starts next year in well below the 200,000 range. We haven't really been at that 200,000 range since, you can sort of see those longer term benchmarks over on the left-hand side going back into the early part of last decade. And that, of course, again, I'll just alert you to data that we've talked about already. This is a slowdown to more norms from about a decade ago, at the same time as we've got population growth, which is going at 2 or 3 times the type of population growth that we had at that time. So the need for housing is strong, but the supply of housing will lag pretty significantly, at least in the next couple of years. There's a provincial picture, but you can look at it quickly now, but I'll move on without much analysis for the sake of time. And I just want to share a couple of comments then, I'm just going to take 1 more minute, Alice. I'm going to share a couple of comments about multifamily. We have seen a fair amount of compression of vacancy rates in the last number of years, notwithstanding a little bit of turbulence during the pandemic, and there continues to be very strong demand for multifamily, but I wanted to share a couple of comments about the composition of that demand. And I'm going to use some long-term norms for how much rental demand there actually is. And so a stylized fact for you to take away is that in the most recent census period, in fact, for the last 10 years of census period, from 11 to 21, we saw rental households representing about half of all household growth in Canada. That was way ahead of where we've ever seen it before. So that's where the rental renaissance comes from. And that was making up for a kind of a 15-year period of when we had almost no rental demand. It's been very topsy-turvy in rental demand over the course of the last generation or so. This is moderating. We're moving into a period where it's about 40%, but because we've got stronger underlying need, like household growth, this is need for housing. They're notwithstanding the construction numbers that will not meet this benchmark, but the need for housing, for rental housing, will subside back to about 40% or so as we go into the next few years on a stronger base. And then my final thing I want to say about multifamily and rental is we did have about 100,000 net new rental households per year in the last census period. And on the left-hand side, it's interesting that only about 20,000 of those, or 20% of rental household growth in the last period, was in purpose-built rental buildings. Condominium apartment units, so investor units, represented a big share as well, but not a majority. In fact, single family homes also represented just about as much as the investor condo market. These would also be investor sale or investor owned units probably. But more recently, we certainly have seen the provision of purpose-built rentals increasing pretty dramatically. It was about 40,000 units during the period that we just studied, 56,000 completions in the last couple of years, and starts in the last couple of years, almost 70,000. So this is getting pretty much a lot closer to the underlying need for rental. And so opportunities in those investor markets will probably be a lot softer, as there's a lot more competition from the purpose-built sector during this period. That's all I've got to say here. Alice, I'm going to turn it back over to you. I know you've been looking at some of the questions that are coming in and may have some of your own, and I haven't left you with very much time, unfortunately, but we do have a few minutes.
No, that's okay. We'll try and get through as many as we can. There's actually quite a lot that did come through on the chat, so if we don't get to you, don't worry, we will reach out offline and make sure that your questions get addressed. And probably a good transition, this one came in fairly early. It's for Ray. Peter, you talked a lot about residential housing starts, but this question reads, given the relatively high construction costs we are seeing in the market, combined with high interest rates for construction and takeout financing, what is your team projecting in terms of new commercial/retail project starts?
You know, it's partly the redevelopment of some of these sites, as well as intensification on some of the retail with added residential. So I think that's still going to, I think, increase, especially as we go through this bit of a transition. And Peter's comments on the multifamily side. So I think definitely office will be off, but retail/mixed use, I think it's going to grow.
Okay. For Peter, do you think that the federal government immigration targets are wise? Are they too high? Understanding that there's a need for labor, perhaps public downside impacts of such high immigration targets on housing availability, costs, food inflation, job availability, unemployment, etc.
I think the general philosophy of ensuring that immigration targets are keeping pace with our labor needs going forward, which almost by definition, because of our slowing labor force, I should say, and shrinking ability to grow our population naturally, almost by definition, that means we need to be thinking about increasing immigration targets kind of on a steady scale going forward. I think that when you increase anything, it doesn't really matter whether it's an immigration target, it doesn't matter whether it's a level of construction or interest rates or anything. If you make a dramatic change from one year to the next in almost any component of the economy, that's going to create waves that will last years. And so I think the very dramatic increase just in the last 18 months of immigration will take us a while, have disruptive influences that will take a while to flow out. Those aren't disruptive influences that would be solved by cutting those targets in half tomorrow. That's actually going to be more disruptive. But it does mean that we're going to have to deal with this in the next few years as we go forward, and we should really target a more steady rate of international migration going forward, with a little bit more steady or moderate increases when we see increases. I didn't talk too much about the composition. A lot of the increase recently has been more net temporary residents that have been coming in for work purposes, but also foreign students that have been coming in. And this has been a dramatic change as well, that we've got a lot more foreign students coming in. There's been some news about that. There's been some potential policy changes going forward on that. But these students are playing a role in terms of helping to finance our our educational institutions as well. So it's hard to just make one change without having other disruptive influences.
Okay, do we have time for one more? I think we're top of the hour here. Thoughts? Okay, well, let's leave that for today. We'll make sure to get back to you. Thanks again, everyone, for attending. And as a reminder, you'll also receive a copy of the presentation. So thanks again, and have a good rest of your day.
Thanks, everybody.
Thank you.